Welcome to TMS Insights May 2020. It's been a really hectic and unusual period in the market. Ben Clark and Jeremy Hook bringing you an update on what's been happening. Ben, April turned out to be a very good month for the market, the best since 1988 after a dreadful and very tough March. So we certainly enjoyed that. And the markets, after a really tough and unknown sort of period, have somewhat found their feet and things are normalising in various ways.
Yeah, I think so. I mean, we're in the same room together now, so that's a good feeling. But yeah, I think what's sort of happened since the last video we sent out is the market has gone from indiscriminate sell down or liquidation that we saw into the 23rd, and then a big bounce in the overall market to now we've seen, the businesses that are going okay through this period and aren't as affected have really run ahead. And there's other companies that are still trading around their March 23 lows because they're facing real issues as a result of Corona. The thing I've been saying to clients is every business on the Australian Stock Exchange faces a unique challenge due to Corona that they could not have forecast and are trying to work out ways to overcome. And it is very challenging working out sort of what the short-term future holds for each business.
I suppose since that last video, one thing we do know is that the fear of some of the cases and deaths and therefore the health impacts haven't materialised in the ways we might have thought. And equally, some of the economic things are starting to play out, but could pick up even sooner with what's expected to be some restriction easing as of even tomorrow.
Yeah, I think if you said 3 weeks ago we'd be where we are now, we just would have been pretty amazed versus what we're telling we were about to face. And, the fact that, the Minister for Tourism is talking about domestic flights running by the July school holidays. It looks like restaurants and cafes could be open in a month. Sports, school going back, we're a long way ahead of where we thought
we could have been, without knowing how it might yet play out. Yeah. That's the thing we can say. Yeah. And equally how it might play out, we're not going to profess today to be able to tell anybody directly because it's got unknowns again. But at least we're at this point, and that's a very encouraging sign.
This is, I think, given what's occurred, we're in a position that we'd never, probably the best case scenario we could have dreamt of 3 weeks ago.
Yeah.
And I think anyone that tells you what the future holds is lying, or they just don't realise that they don't know. So, because there's so many different ways that this could play out, and hopefully it continues to be the way that we've seen so far.
Yeah, and we know that investing in high quality companies over time, including in times of crisis, delivers good results.
Yeah.
One thing we do also know, it's a busy time for a lot of companies because they've got to, in this event that they couldn't have foreseen, replenish their balance sheets to get through and then to thrive on the other side. So we've seen a lot of capital raising. So we've actually been really busy at TMS, and we've been in touch with a lot of clients about a whole series of raisings. So let's try to cover off on them, Ben. And the very first one that came out was NextDC, data centres getting on the front foot to open a new centre.
Yeah,
which that's good. That's a good reason.
Yeah, so I think that if you look at how the raisings have fared to date, the companies that are raising to fund growth the share price have performed much better than companies that are raising for balance sheet repair. And NextDC would be in that growth area. Yeah. And it's also probably one of the few remaining areas of property that's got a pretty good outlook at the moment.
Yeah,
so I think it's probably a fair bit of money pushing into that pipeline.
Other stocks like Flight Centre, totally the opposite. Obviously, it's had the worst impacts of this. I think their business is about 3% of what it was a year ago, roughly. So incredible. And just hard work. 800 stores closed, a big capital raising. They'll live to fight another day, but these are pretty tough times.
Yeah, and we've seen, so this Flight Centre Webjet, which from all accounts nearly went broke through this period, and Auckland International Airport, which is probably one of our biggest ones that we've had to do recently, all at the coalface of what's going on. I'm more of an optimist on this sector than others are. I tend to think that human behaviour will see people wanting to travel, and particularly once a vaccine is developed, that's probably the that's the golden chalice that we're all hoping for in this area.
Yeah.
But the valuations of these businesses got destroyed, and the market is still pricing in a very long period of no growth, which I think might be a bit too pessimistic.
Yeah, and whatever time frame it'll be, the market will begin to reprice it upwards well before the full resumption of travel, for example.
Yep.
But AIA, we may stay on that for a sec because that highlights some of the challenges of this capital raising cycle. So at roughly half their previous COVID price, they were trading around $9. They issued a share purchase plan at effectively $4.39, so a long way down. And we were trying to apply for up to $47,000, but we got rats and mice in that band. So that stock travelling around the mid $5 range at the moment still looks very interesting on a long-term basis.
Yeah, I think, you said something to me the other day, which you said share purchase plans have become quasi-rights issues. And we're seeing scale-back policies this time around the capital raising cycle that we haven't really seen before, where, and, it is fair to a point, but it's sort of unfair in that it's not, you're not given a heads up before the share purchase plan that this is the treatment that might occur, where larger shareholders are getting much larger allocations and smaller shareholders getting much smaller allocations. I've been surprised the demand for the raisings has been very strong.
Yeah, when you think about the share purchase plans, some of the rights issues not, like Flight Centre and the G8 was another one where there were quite a lot of take-up by the underwriters in those cases. So they're different.
Instos are going hard at them.
They are. Reece was an interesting one.
Yep.
Share purchase plan there, just by contrast, got the lot, didn't it?
Yeah, 30,000 took the lot. Cochlear was a very nasty scale back.
Very nice.
And AIA was, I thought, particularly nasty. But, they received 430 million in applications for 200 million of stock. So they've got to work out a way to do it.
Yeah.
But it's probably something, because there's going to be more raisings coming.
Let's talk about the ones that are in front of us now. We know Invicare's coming up.
Yep.
And that's a classic case of a defensive business that you wouldn't have expect get hit by a recession, but a recession where you've got to have social distancing. Yeah.
10 people at funerals.
That's it.
Yeah. So, my view on Invicare is this is a pretty good point in its cycle to be buying. And this stock was trading at $14 pre-COVID. It had an upgrade in February. The business was actually travelling really well until this, out of nowhere, 10 people at a funeral. But Northern Territory and South Australia have since lifted funeral numbers. Scott Morrison said a couple of days ago that it will be one of the first things to be relaxed.
Yep.
Because he said, I'm painfully aware of how hard that is on people. So they're probably one of the first businesses that should get the benefit of an easing.
Yeah. And the other ones coming up, Cube and Lend-Lease, a rights issue and a share purchase plan respectively. That rights issue on Cube is very well priced, so that should be good.
Lend-Lease is well priced as well. But probably going to get overrun.
And this is the issue in aggregate. These are a lot of raisings for people, so not everybody can take up everything.
Yep.
And it does put a little bit downward pressure on stock prices, potentially for a short period while this is going on.
Yep.
Now, I want to mention NAB, which is one of the big banks in this period that's raised capital, and a share purchase plan coming, but also to talk about bank dividends, which ANZ and Westpac have temporarily suspended, deferred. We'll see whether they end up paying those. But NAB, small dividend and a big raising.
It made no sense to me. I just don't understand why you pay a token dividend and then have to do an even bigger capital raising at a discount to book value. It just doesn't make sense.
And that's the point. It's a discount to book value of some magnitude. So
and we've never, I was just saying actually to a client on the phone, in my career, 20 years in the market, I've never seen the banks trade at discounts to book value. So we've always traded at premiums, even through the
virtually 2 times assets. It's typical, and
so the valuations are attractive.
Oh yeah, and they're under some earnings pressure, but long term attractive. And on the other side of this, the returns could be fantastic for a cosy oligopoly like the bank sector is. So don't rule it out forever, even though the dividends are low now. The cancelling of a dividend is often a turning point for a stock.
Yep. So, well, that's, I remember BHP when they finally fell on the sword, half the dividend, that was the low in the share price. And it's the instos will clap it. They'll be happy that the business is doing that.
And we don't want to be mugs by feeding that the other way. A couple of stocks that were reported just in the last little while, Ben, that have reaffirmed good dividends. Spark Infrastructure. That's
an interesting one, because I think there is, I think the most unfair thing about this sell-off, Jeremy, is it's been the most defensive, sort of more boring kind of companies that have fallen a lot further than the growth stocks, which isn't what you would normally expect during this sort of market. And, the property trust sector, the banks, the infrastructure stocks have been very weak. And it's because of the unique sort of issues around the virus, these problems that it's created that you couldn't have foreseen. And so, Spark is one that still offers a business that hasn't been impacted and is on a yield of about 7% with some franking. And it's increasingly hard to find something like that. So, that's for those who don't have it and are looking for income, that's a good place. It's a standout.
Medibank Private, like NIB, reaffirmed they're actually paying out a lot less claims in this environment. So that's quite handy for them. That's a good yield. The other one that silently, just without a lot of fuss, increased its dividend again in the middle of this ruckus was Soul Pattinson.
Yeah.
And I'm sure it'll do that again at the end of the year.
Yeah.
So great business that does that through difficult times.
And paying out a realistic payout ratio through the good times.
That's it.
And I think this is one thing that in a post, we're all talking about the world's going to change and what does the world look like going forward. From a share market point of view, I think one thing that is going to change is payout ratios are going to get a bit more realistic. Too many companies were paying out too high a portion of their profits as a dividend. And if you've got to raise it, is it really that good an idea? I think the other thing that clients might need to continually get their mind toward is investing in the best quality businesses, even if the dividends are low, and looking at a total return rather than being too income focused. Because as we've seen, the income focused stocks are fallen the furthest.
And that's a nice segue to go to the international stocks, which reported over the last few weeks. And we won't go deeply into each of these at the moment, but we don't get much income from our international leaders, our Amazons, our Googles, and our Microsoft, etc. But the phenomenal performance of these companies in an operating sense and a share price sense over this period stands out in global markets and in client portfolios.
Yeah, absolutely. I mean, I think this is, we've been talking about international for over a year now, and probably one of the better things that we did last year was to start speaking to clients about maybe reducing Australian share exposure and looking at international exposure. And, if I'll give you one sort of takeaway from the Microsoft CEO when they reported their quarterly result last week. He said that 2 years of digitisation has occurred in the last 2 months. And what he means by that is this inevitable trend that we've seen around technology has accelerated as a result of Corona. And so companies like Amazon, Facebook, Google, etc., and Microsoft are actually benefiting from what's going on.
Growth in cloud, growth in streaming,
all those
Netflix
things.
has had a fair work at it. The
YouTube's
Clark household, you've been watching a few Netflix specials. No, it's been an interesting time and we've all got through it. But I think overall, Ben, the message for our clients to be left with today is it's been busy for us, but we're actually pretty pleased the way we've been able to help negotiate clients through this really difficult period in the market. And I think we're in a good position to, notwithstanding the unknowns of the virus, to get through the middle of the year and to look to this one in the rearview mirror as a time which we actually kept things together from which we can grow nicely in the future.
Yeah, definitely. I think I've been really happy with how we performed through a pretty nasty or very nasty market, but most importantly where we bounce back to now. I think performance has been very solid, and we've really had, there's lots to worry about, but we haven't had something specifically to worry about in terms of a company or anything like that. And the share purchase plan stuff, there is a lot of work going on, but it's making everyone a few $1,000s potentially each time we're doing it for them, and we're trying to make as much money as we can for everyone and get our clients through this as well as we can. So hopefully we've helped to do that.
Yeah, absolutely. All right, that's all we've got time for today. We'll be back in touch again in June.